Breaking. Silver hits $77 in Shanghai, while Western banks just got caught at 72 December 2025. 47.6 million ounces of silver claimed for physical delivery in just 4 days. That's 60% of COMEX's entire available inventory gone. The vault doors opened, and the metal wasn't there. Shanghai is trading at $77. New York is stuck at $70. That's not an arbitrage opportunity. That's a crisis. When paper promises meet physical reality, someone has to lose. And this time, it's the institutions that convince themselves. This day would never come. What happens when the world's most trusted commodity exchange runs out of the very metal it's supposed to deliver? The answer is unfolding right now. Welcome to Financial Announcement. My name is Marcus Rahman. I'm a commodity markets analyst based in Singapore, and for the past 12 years, I've tracked precious metals flows across global exchanges. Today's story isn't about speculation. It's about mathematics meeting reality. Before we begin, if you're over 50 and you remember when a handshake meant something, when contracts were honored, when the paper in your hand actually represented something real, then you'll understand why this story matters. Hit that subscribe button. Because what's happening in silver markets right now is a lesson every serious person needs to understand. And tell me in the comments, where are you watching from? London, New York, Mumbai, Shanghai? Because geography matters in this story, more than you might think. Let's begin. December 2025 began like any other month in the precious metals markets, until it didn't. On December 2nd, traders at the Chicago Mercantile Exchange noticed something unusual. The silver delivery requests were spiking, not just rising, spiking. In the first 4 days of the month, something unprecedented happened. 47.6 million ounces of silver were claimed for physical delivery from COMEX vaults. To understand why this matters, one needs to understand how commodity exchanges actually work. COMEX is not just a marketplace. It's the backbone of silver price discovery for the entire Western world. When someone buys a silver futures contract, they're not usually buying actual metal. They're buying a paper promise, a contract that says they have the right to demand physical silver at a specific price on a specific date. Most of these contracts never get converted to physical metal. They get sold, traded, or settled in cash. The system works because everyone trusts that if they wanted the actual metal, they could get it. But what happens when everyone wants it at the same time? COMEX maintains two categories of silver inventory: eligible inventory and registered inventory. Eligible inventory is metal sitting in COMEX-approved warehouses, but it's already owned by someone. It's not available for delivery to contract holders. Registered inventory is different. That's the metal actually available to fulfill delivery requests. On December 1st, 2025, COMEX's registered silver inventory stood at approximately 79 million ounces. By December 4th, delivery requests had consumed 47.6 million of those ounces. That's more than 60% of the available supply. Gone in 4 days. Analysts started using a term that rarely appears in commodity market reports: a vault drain emergency. Marcus Rahman sat in his Singapore office watching the data streams with growing concern. He had seen drawdowns before, but nothing like this. The velocity was what shocked him. Not the total amount, but the speed. On December 3rd alone, 7,330 silver futures contracts requested physical settlement. Each contract represents 5,000 ounces. That's 36.65 million ounces claimed in a single day. To put this in perspective, that single day's delivery demand represented roughly 30% of COMEX's entire free-float inventory. One day. But here's where the story gets even stranger. While COMEX vaults were hemorrhaging metal, silver prices were doing something peculiar. On December 24th, silver hit $72.36 per ounce in New York, a 143% increase compared to the same date the previous year. That kind of rally doesn't happen by accident. It happens when fundamental forces collide. Two specific catalysts were driving the surge. First, expectations of U.S. interest rate cuts. When interest rates fall, the opportunity cost of holding non-yielding assets like silver drops dramatically. Investors stop losing money by not holding bonds, and precious metals become attractive again. Second, geopolitical tensions were escalating. The Trump administration's Venezuela oil blockade had created uncertainty in energy markets. Middle East tensions were rising, and institutional investors were seeking safe haven assets. But the real puzzle wasn't happening in New York. It was happening in Shanghai. While COMEX was struggling with massive delivery demands and climbing prices, Shanghai Futures Exchange was reporting something completely different. Silver inventories in Shanghai had hit decade lows, below 446 tons by the end of November, the lowest level since 2016. In October alone, over 300 tons had vanished from Chinese vaults. Where did it go? It went west. Shanghai, traditionally a net importer of silver, had reversed course. Chinese silver was flooding into London and New York in unprecedented volumes. This wasn't normal market behavior. For years, the flow of silver between east and west followed a predictable pattern. When Shanghai prices ran higher than London or New York, metal flowed east. When Western prices offered better returns, metal flowed west. The system balanced itself through arbitrage. Traders would buy where it was cheap and sell where it was expensive. The flows evened out. But in December 2025, something fundamental had broken. Shanghai was exporting silver to the west, even as Western vault inventories were collapsing at historic rates. And here's the detail that made Marcus Raman's hands go cold. On December 24th, while New York silver traded at $72.36, Shanghai silver hit $77 per ounce, a $5 spread. In precious metals markets, that kind of sustained price differential between major exchanges doesn't represent opportunity. It represents crisis, because if Shanghai is willing to pay $77 for metal, and Western banks are stuck trying to deliver contracts at $72, someone is about to lose a staggering amount of money. The math was simple and brutal. COMEX registered inventory had declined by 73% since 2020. The drain wasn't gradual anymore. It had reached crisis velocity, and the people claiming physical delivery weren't speculators hoping to flip contracts for profit. They were industrial users who needed silver for manufacturing, institutional investors who wanted metal they could actually touch, and sophisticated traders who looked at COMEX inventory levels and decided paper promises weren't good enough anymore. When participants in a commodity market stop trusting the exchange can deliver, when they start demanding the physical metal instead of accepting paper settlements, that's when the real danger begins. Because once credibility breaks, the mathematics become unstoppable. Marcus Raman pulled up his historical data. The last time anything remotely similar happened was 1980, when the Hunt brothers tried to corner the silver market, but that was manipulation. This was something different. This was the market simply running out of metal, and the Western banks who had written contracts at $72 were about to discover what happens when the vault doors open. And the silver isn't there. To understand how Western banks found themselves trapped in December 2025, one must first understand a system that has operated quietly for decades, a system so elegant in its design that it convinced everyone it could never fail. The COMEX silver futures market wasn't created for speculation, at least not originally. In the 1970s, when these contracts were first designed, they served a legitimate purpose. A solar panel manufacturer in Arizona needed to know what silver would cost 6 months from now. A mining company in Nevada needed to lock in prices for ore they hadn't extracted yet. The futures market let them hedge against uncertainty. Both parties signed a contract. Both parties got certainty. The system worked. But over the following decades, something transformed. For every industrial user who actually needed physical silver, there were now 50 speculators who just wanted to bet on the price. And the exchanges welcomed them because liquidity is profitable. Here's where the architecture gets interesting and dangerous. COMEX operates on what's essentially a fractional reserve system. Just like banks, a bank doesn't keep every depositor's money sitting in the vault. It lends most of it out. It only keeps enough cash on hand to meet typical daily withdrawals. The system works because not everyone withdraws their money at the same time. COMEX applies the same logic to silver. The exchange doesn't require enough physical metal to back every contract, because historically, only 1.3% of contracts ever request physical delivery. The rest settle in cash or roll over to future months. So the math worked beautifully. If you have 100 million ounces of registered inventory, and you know only 2% of contracts will demand delivery, you can confidently write contracts representing 5 billion ounces. The leverage is massive, the profits are enormous, and the risk seems negligible. Marcus Raman had studied the system for 12 years. He knew the leverage ratios. He understood the statistical models banks use to calculate delivery probability. What he also knew was something darker. Every fractional reserve system has a breaking point. It's called a bank run. Between 2010 and 2023, the system hummed along perfectly. Delivery requests stayed predictable. Registered inventory remained stable. The banks made fortunes on the spread between paper prices and the minimal cost of maintaining physical reserves. Major financial institutions held massive short positions in silver futures, essentially betting that prices would fall or remain stable. And when they wrote those contracts, they never seriously considered they'd have to deliver actual metal. Why would they? The data supported their confidence. Decade after decade, the statistics held. But by 2020, something began shifting in ways the models couldn't capture. 3 separate demand streams were converging, and nobody was accounting for their compound effect. First, the green energy revolution. Solar panels require significant amounts of silver. Every megawatt of solar capacity installed meant more industrial demand. Electric vehicles use twice as much silver as traditional cars. As EV production ramped up globally, so did silver consumption. By 2024, industrial demand for silver had increased 37% compared to 2020. But the bank's statistical models still used historical delivery rates from the 2010s. Second, the investment demand dynamics were changing. For years, investors seeking silver exposure bought ETFs, paper instruments that claimed to hold physical metal. But after 2022, trust in these instruments began eroding. Investors started asking uncomfortable questions. Do these ETFs actually hold the metal they claim? What happens if everyone redeems at once? The questions led to action. More investors started demanding physical delivery instead of trusting paper proxies. Third, and most critical, was China's strategic pivot. Between 2016 and 2023, China had been the world's largest silver importer. Chinese vaults accumulated metal steadily. Shanghai Futures Exchange inventory climbed year after year. The Western banks factored this into their models. China was absorbing supply, reducing pressure on COMEX. Everything balanced. But in late 2024, the flow reversed, suddenly and dramatically. October 2025 saw 300 tons disappear from Shanghai vaults. November pushed inventories to decade lows. December turned China from net importer to aggressive exporter. Marcus Raman spent weeks trying to understand why. The explanations ranged from currency manipulation to geopolitical positioning, but the effect was undeniable. Chinese silver was flooding Western markets. And rather than relieving pressure on COMEX, it was exposing something terrifying. Even with Chinese metal flowing west, COMEX couldn't keep up with delivery demands because the Chinese weren't sending metal to replenish COMEX vaults. They were sending it to private buyers willing to pay premium prices. The Shanghai price told the whole story. And while New York struggled at $72, Shanghai was paying $76. That $5 spread wasn't an inefficiency. It was a market screaming that Western pricing mechanisms had disconnected from physical reality. The arbitrage that should have closed this gap wasn't working because there wasn't enough physical metal in Western vaults to arbitrage. You can't buy silver in New York at $72 and sell it in Shanghai at $77 if New York doesn't actually have the silver to sell you. The paper market had become untethered from the physical market, and the institutions that had built their positions on leverage and statistical probability were about to learn a brutal lesson about the difference between paper and metal. By early December, some traders had started calculating the exposure. If even 10% of open silver contracts demanded physical delivery, COMEX couldn't fulfill them. Not even close. The registered inventory had declined 73% since 2020, from roughly 300 million ounces to just 79 million. Meanwhile, open interest in silver futures had actually increased. More contracts, less metal. The leverage ratio had exploded. Marcus Raman pulled up the Federal Reserve data on interest rate expectations. The Fed was signaling cuts in early 2026. When rates drop, investors flee bonds for hard assets. That meant more delivery requests were coming, not fewer. He then cross-referenced geopolitical risk indicators, Venezuela, Middle East, trade tensions. Every escalation drove more safe haven demand, more institutions wanting physical metal they could hold. The perfect storm wasn't theoretical anymore. It was forming in real time, and the banks that had spent decades profiting from the paper-physical spread were about to discover what happens when the mechanism breaks, because the system only works when everyone believes in it. When industrial users trust they'll get their metal, when investors trust the contracts are backed by real reserves, when the statistical models hold true. But in December 2025, belief was evaporating, replaced by a simple, urgent demand, show me the metal. And when the vault doors opened, the metal wasn't there. Not enough of it. Not nearly enough. The house of cards built on fractional reserves and statistical confidence was beginning to collapse, and the banks holding short positions at $72. While Shanghai paid $77, we're trapped. Every financial crisis has a prologue, a series of warnings that seem obvious in hindsight, but were dismissed as noise at the time. The silver crisis of December 2025 was no different. The signs were there, flashing red for years, but the institutions that should have been paying attention chose to look the other way. Marcus Raman remembered the first warning clearly. It came in March 2021. A small mining analytics firm in Toronto published a report projecting that solar panel production would require 140 million ounces of silver annually by 2025, up from 85 million ounces in 2020. The report included detailed breakdowns. Photovoltaic cell efficiency improvements required more silver per panel, not less. Government green energy mandates were accelerating installation timelines. The math was straightforward. The report was ignored. Why? because the major banks had their own analysts, their own models, their own decades of data showing that industrial demand fluctuations never significantly impacted delivery rates. The Toronto firm's projection didn't fit the pattern, so it was dismissed. Recency bias is a powerful drug. When something works for 15 years straight, the human mind convinces itself it will work forever. The second warning came in August 2022. COMEX registered inventory dropped below 200 million ounces for the first time since 2016. A 15% decline in just 8 months. Trade publications noted the decline. A few independent analysts raised eyebrows, but the institutional response was unified. Temporary market adjustment. Seasonal variation. Nothing to worry about. After all, 200 million ounces was still substantial, and delivery requests remained at historical norms, less than 2% of contracts. The banks ran their stress tests. Even if delivery requests doubled, they'd be fine. The model said so. But the models were built on assumptions that were quietly becoming obsolete. Assumptions about investor behavior, assumptions about industrial demand growth rates, assumptions about China's role in global silver flows. By mid-2023, the third warning emerged, and this one was harder to ignore. Chinese import data showed unusual patterns. Month after month, Shanghai was absorbing record amounts of silver, but the metal wasn't appearing in Shanghai Futures Exchange inventory reports. Where was it going? Private vaults? Industrial stockpiles? Strategic reserves that didn't show up in public data? A commodities researcher in Hong Kong named Dr. Wei Chen published an analysis suggesting China was building unreported silver reserves, potentially preparing for a future where Western supply lines became unreliable. Her paper was shared widely in academic circles. It was discussed at conferences, and then it was forgotten. Because acknowledging Dr. Chen's thesis meant acknowledging something uncomfortable. That China might be playing a longer game than Western institutions understood. That the global silver market might be less stable than everyone assumed. So the thesis was filed away. Interesting, but speculative, not actionable intelligence. Marcus Raman had read Dr. Chen's paper twice. He found her analysis compelling, but even he didn't act on it. Because acting would have meant going against the entire institutional consensus, betting against the system. And the system had been right for so long. The fourth warning came in November 2024. COMEX registered inventory fell below 100 million ounces, a 50% decline in less than 2 years. This time, the decline made headlines. Bloomberg ran a piece, Reuters covered it. Financial analysts were finally asking questions, but the banks had an explanation ready. Inventory is being reclassified from registered to eligible status. This represents accounting changes, not actual metal leaving the system. Total COMEX inventory, including eligible, remains robust, technically true, but deeply misleading. Eligible inventory can't be delivered to contract holders. It's already owned by someone else. The distinction matters. The distinction is everything. But the explanation was accepted, the headlines moved on, and the warning was forgotten. By early 2025, the warnings were no longer subtle. They were screaming. January saw delivery requests spike to 3.2% of open contracts, still low by crisis standards, but 60% higher than the historical average. February continued the trend. March saw it accelerate. But each month the banks found explanations. Short-term volatility, seasonal hedge adjustments, one-time portfolio rebalancing by a large institutional player. Never. This is a structural shift in market behavior that threatens our entire position. Because acknowledging that would have required action, closing short positions, accepting losses, admitting the models were wrong. So instead, they doubled down, convinced themselves the trend would reverse, waited for the data to confirm their beliefs. This is how intelligent people make catastrophic mistakes, not through stupidity, but through motivated reasoning. When your salary depends on a system working, you find reasons to believe it will keep working. Marcus Raman watched the delivery requests climb month after month. He watched registered inventory decline week after week. He watched the gap between Shanghai and Western prices widen, and he knew what was coming. But even he hesitated, because betting against the entire Western financial establishment seemed like madness, until it was obvious. The fifth and final warning came in October 2025. Shanghai inventory dropped 300 tons in a single month, and Chinese silver started flowing west in unprecedented volumes. This should have been the ultimate red flag. China, the world's largest silver consumer, was exporting, not because they had excess, but because Western buyers were desperate enough to pay premium prices. Dr. Wei Chen published a follow-up analysis, arguing that China had completed its strategic accumulation and was now exploiting Western supply shortages for geopolitical advantage. This time, her paper wasn't ignored. It was actively disputed. Major banks published counter-analyses, arguing that Chinese exports were simply rational arbitrage, nothing strategic about it. But the counter-analyses couldn't explain one critical fact. If this was simple arbitrage, why wasn't the price differential closing? Why was Shanghai still paying $5 more per ounce than New York? The answer was uncomfortable, because there wasn't enough metal in Western vaults to close the gap. By November 2025, some smaller hedge funds started quietly closing their short positions, taking losses, but getting out. They saw what was coming. The major banks didn't, or couldn't, because their positions were too large to unwind without triggering the very crisis they feared. They were trapped by their own leverage. December 1st arrived, and with it, the flood of delivery requests, 47.6 million ounces in 4 days. The warnings hadn't been wrong, they'd been early, and in markets, early warnings are indistinguishable from false alarms until they're not. Marcus Raman sat in his Singapore office on December 5th, looking at the delivery data, looking at the inventory reports, looking at the price spread between Shanghai and New York. Every warning had been there, every signal had been flashing red. The question wasn't whether Western banks would get caught. The question was what would happen next, when the music finally stopped and everyone realized there weren't enough chairs. December 12th, 2025. A conference room in Lower Manhattan. 7 senior executives from 3 major Western banks sat around a table. The numbers in front of them told a story none of them wanted to believe. Their institutions collectively held short positions on 180 million ounces of silver, contracts written at an average price of $68 per ounce. The current market price was $72.36 and rising. Shanghai was paying $77, but price wasn't the real problem. Availability was, because even if they wanted to buy physical silver to cover their positions, there wasn't 180 million ounces available for purchase. Not at any price. The metal had simply vanished from the market. One executive, a risk management director named Catherine Wells, asked the question everyone was avoiding. What happens if we can't deliver? Silence. Because the answer reshaped everything they understood about modern commodity markets. If COMEX couldn't fulfill delivery requests, if the exchange had to force cash settlements instead of physical delivery, the entire credibility of Western price discovery would collapse. Futures contracts only work if participants believe they can get the underlying asset. The moment that belief breaks, the contracts become worthless, and with them, the entire pricing mechanism for silver in Western markets. Marcus Raman had been modeling this scenario for weeks. The mathematics were brutal. If COMEX registered inventory continued depleting at current rates, the exchange would hit zero by mid-January 2026. Zero. Not low inventory, not tight supply, complete depletion of deliverable metal. At that point, COMEX would face 3 options, none of them good. Option 1, change the rules. The exchange could modify contract specifications, force cash settlement instead of physical delivery. Essentially, tell contract holders, we know we promised you metal, but here's money instead. This had historical precedent. During the 1980 Hunt Brothers crisis, COMEX changed margin requirements mid-trade, effectively rigging the game to prevent market collapse. They could do it again, but the consequences would be severe. Every industrial user who relied on COMEX for legitimate hedging would immediately lose trust. Every investor holding futures contracts would question whether their positions meant anything. Every arbitrage mechanism linking Western and Eastern markets would break. Shanghai would become the global price setter by default, because Shanghai could still deliver physical metal. Western markets would become irrelevant sideshows. Option 2, source emergency physical supply. The banks could scour global markets for available silver, buy from secondary sources at premium prices, take massive losses, but fulfill delivery obligations. The problem was scale. Where do you find 180 million ounces of silver when global visible inventories were already depleted? Mining companies couldn't accelerate production overnight. Silver is primarily a byproduct of copper, lead, and zinc mining. You can't just mine more silver on demand. Government stockpiles existed, but governments don't typically sell strategic reserves to bail out private banks. The only realistic source was China, and China was already exporting. But to private buyers paying premium prices, not to Western banks trying to cover underwater positions. Catherine Wells had already made inquiries through back channels. Chinese state-owned enterprises were willing to sell at $82 per ounce for immediate delivery. That was a $14 loss per ounce on positions written at $68. For 180 million ounces, the losses would exceed at $2.5 billion. And that was if China would even sell that volume, which they probably wouldn't. Option 3, negotiate with contract holders. The banks could approach industrial users and large investors directly, offer cash settlements at premium prices, Essentially, pay people not to demand physical delivery. Some would accept, especially financial speculators who didn't actually need the metal. But industrial manufacturers couldn't accept cash. They needed physical silver for production lines, solar panel manufacturers, electronics companies, medical device producers. They had their own contracts to fulfill, their own production schedules to meet. Cash settlements didn't help them, and if even 30% of contract holders insisted on physical delivery, the banks would still face catastrophic shortfalls. Marcus Rahman understood that all three options led to the same destination: a fundamental repricing of silver and a permanent shift in how global markets valued paper claims versus physical assets. Because the real lesson of December 2025 wasn't about silver specifically. It was about leverage, trust, and the mathematics of fractional reserve systems. The same mechanics that were breaking silver markets existed in other commodities. Copper inventories at the London Metal Exchange had been declining for 18 months. Platinum-registered inventories were at 5-year lows. Lithium markets were experiencing similar paper-to-physical disconnects. The silver crisis was a canary in a coal mine, warning that the entire commodity futures system had become over-leveraged, too dependent on statistical models, too confident that historical patterns would continue indefinitely. For industrial users, the implications were immediate and practical. If they couldn't trust futures markets for price hedging, they needed alternative strategies. Some were already moving: vertical integration into mining operations, long-term supply contracts with producers, building physical stockpiles despite the capital costs. A solar panel manufacturer in Arizona had quietly purchased a 12-month supply of silver in November, taking delivery of physical metal and storing it in private vaults. The CFO had been mocked by peers for tying up capital unnecessarily. By December, those same peers were calling, asking if he had any excess to sell. He didn't. For investors, the crisis forced a fundamental question. What does ownership mean in financial markets? If you hold a futures contract, but the exchange can't deliver the underlying asset, do you actually own anything? Or do you just own a promise? A promise that's only worth something if someone honors it? This philosophical question had practical consequences. Investors were shifting from paper silver instruments to physical holdings: coins, bars, allocated storage in private vaults, things they could touch, count, verify. The premium for physical silver over paper contracts widened. Physical silver traded at 4 I-7 per ounce above futures prices. Because physical meant certainty, paper meant counterparty risk. For the broader financial system, the silver crisis exposed uncomfortable truths about leverage, about the gap between paper claims and real assets, about what happens when statistical models meet black swan events. The derivatives market for silver was estimated at over $500 billion, built on a physical market worth perhaps $30 billion annually. That's $16 of paper claims for every dollar of real metal. The leverage worked beautifully. Until it didn't. Marcus Rahman finished his analysis on December 18th. His conclusion was stark. The Western banking system hadn't been caught by manipulation. They'd been caught by mathematics. When you write more promises than you can fulfill, when you assume historical patterns will never change, when you prioritize short-term profits over long-term stability, eventually, reality presents the bill, and reality doesn't negotiate. The silver market of December 2025 would be studied for decades, not as an anomaly, but as a case study in institutional complacency. The banks that got caught at $72 while Shanghai traded at $77 learned an expensive lesson about the difference between paper and metal, but the real question wasn't whether they'd survive this crisis. Most would. They'd take losses, restructure positions, move on. The real question was whether anyone would learn the deeper lesson, that systems built on leverage and trust only work until they don't. That credibility, once lost, cannot be recovered with spreadsheets and models. That, in the end, physics beats finance. Every single time. The music had stopped, the chairs were gone, and everyone was finally counting, discovering that the numbers never added up in the first place.